Thank you, Scott. Welcome to The Exchange. I'm Melissa Lee, in today for Kelly Evans. Stocks lower following a much hotter than anticipated PPI inflation report and concerns over how it could impact the Fed's next move. Yields, they are moving higher. The two-year yield back up to 3.74%. It was sitting at a multi-month low prior to the release of the PPI, the 10-year at 4.29%. Bitcoin under pressure, this after hitting an all-time high, crossing the 124 level, 124,000 that is, now hovering just around 117K as investors de-risk following PPI. Also of note, Treasury Secretary Bessent ruling out buying more Bitcoin for the reserve. But we begin with the latest data point on the economy, putting into question whether the Fed will cut rates in September, and if so, by how much. Senior economics reporter Steve Leisman is here, along with Jefferies David Zervos, who was just added, by the way, by the White House to the growing list of potential candidates to replace Fed Chair Jay Powell. We've got a lot to get to. Of course, we'll get to David on whether or not he'll be the next Fed chair. But first to Steve, who'll set the stage with today's data.
I'll venture that David doesn't have an answer to that question, but we'll get back to that.
We'll get back to it.
A surge in wholesale prices giving just a bit of pause to the Fed September rate cut freight train, and some renewed thought to the idea of a September rate cut pause or rate pause. The producer price index rising 0.9%, the fastest gain since the inflation of the pandemic. Takeout food, takeout energy, and trade services. The gain was still a pretty robust 0.6%. Economist Matthew Martin from Oxford writes, tariff-exposed goods are rising at a rapid clip, indicating that the willingness and ability of businesses to absorb tariff costs may be waning. Matthews found that the gain in tariff-exposed goods was more than double the level for non-tariff-exposed goods. J.P. Morgan writing, quote, the fact that there is upward pressure across all recent inflation reports that is not directly attributed to tariff goods may give some Fed officials pause. Well, St. Louis Fed President Alberto Musalem, in a CNBC exclusive interview, sounded like one of those officials who have some of that pause.
When we see tension between our two mandated goals, we need to follow a balanced approach, which is to think about three things: the probability of a miss on employment versus the miss on inflation, the potential size of the miss on each side of the mandate, and the potential duration of the miss on each side of the mandate.
Despite the data, the futures market continues to price in a strong 93% probability of a rate cut in September, though it did price out the cut in December and now puts a modest 7 percentage point probability on no September cut. PPI data can be volatile. Want to be careful with it, subject to revisions as well. Importantly for the Fed, as Musalem pointed out, there's another jobs and another inflation report before the next meeting.
If you back out the gains in portfolio management, asset management, those prices, what would PPI be? Because a big driver of the services side was in brokerage services.
I will look up, do you know what, David, the X services? I just gave you the X food, energy, and services.
Right.
It took out three volatile areas. It was still 0.6. And that was still higher than expected, and it still shows some of the pass along. And the services number, forget the portfolio side. There's something funny going on. It may have to do with accounting for tariffed inventory versus non-tariffed inventory. I haven't gotten to the bottom of it yet.
Okay.
But I came in today at 8:29 this morning, fully expecting to see the services thing is the margin. I thought that was going to collapse because I thought they were absorbing it. That's what we're hearing from some of the Walmarts and Targets out there.
Yeah.
But it wasn't in the data. So something squirrely is going on with the services number, and I'm not sure. I don't care about the portfolio services. Yeah. Stock market rise, portfolio management, profits rise. But something's going on with the retail margins and the wholesale margins. They should be collapsing if they're not passing along the tariff goods. Maybe David has a better answer.
Yeah. We want to get to that, but I do want to read the White House response to this morning's PPI data. With CPI running at an annualized rate not seen in over 4 years, and PPI for core goods, which would be most sensitive to tariffs, now down at a 0.7% annualized rate since January, the doom and gloom predictions of President Trump's tariffs ratcheting up inflation continue to be proven flat out wrong. Trump administration's policies swiftly put an end to President Biden's inflation crisis, and as trillions in investments pour into the U.S., they are now laying the groundwork for a long-term economic resurgence for the American people. All right, let's officially now bring in David Zervos, Chief Market Strategist at Jefferies, as well as a CNBC contributor, also on the not-so-short list of 11 candidates who may replace Jay Powell. Welcome, David.
That was a long introduction, Melissa.
It was. I mean, there's so many mantles which you carry these days. But
and a frequent guest here, which is how we know him. We don't really care about the other stuff.
What did you make of the number today?
I don't make a lot of it.
Okay.
Steve said it's a very volatile number. There's some really quirky stuff on the services side. I think 80% of this gain was in services. There was the good side was relatively tame. Also, if you look back at core PPI, the year-over-year figure, we were cutting rates when this number was even higher in Q4 of last year. So the September, October, November, December prints for that core PPI were higher than this 3.7 number that came out. So to be honest with you, and Jay was perfectly comfortable cutting rates then. He's not very comfortable with it now. I think a lot of this stuff is noisy. It doesn't make its way through to core PCE, doesn't make its way to core CPI, and we'll see that in the numbers ahead. And there's been a lot of very good news on inflation, at least to start the year, and certainly over the last couple years as we've come from those incredibly high levels.
So the narrative today that this number may give the Fed a reason to pause or to rethink cutting rates, any of that, along with CPI and the fact that services side of CPI was greater than what had been anticipated and goods remained fairly tame. None of this changes your view about what the Fed should do.
Well, you cast that in a very unusual way for me. I have been over many years here at this table and other tables on the network, been very careful not to talk about what the Fed should do, because I've never really felt like what I thought the Fed should do mattered. I just tell you what I think the Fed will do. Now that's a little different, Melissa, so I think I'm sitting in a position with a very esteemed group of people, and I'm very honored to be there, where maybe what I think the Fed should do does matter. And we've had on this show, I think for the last 6 or 8 Fed meetings, Kelly has asked about, what you think, what you would do if you were there. We had a shadow committee. I think in the last 3 meetings I have said I would say 50 basis points. I was one of the few. I think there might be one other in that shadow committee that they're putting up there. And I'm still there. I'm still absolutely there. I think there is a reasonable storyline, a very cogent storyline that suggests monetary policy is restrictive. It's gotten more restrictive. The arguments I put forward have been related more to the balance sheet and that contraction. But generally speaking, I don't see any reason why this number changes that view.
So a 50 cut in September. After that, though, would you be data dependent and open to the idea that tariffs may then translate into inflation later on in a few months down, which a lot of economists out there, like Jan Hatzius of Goldman Sachs, for one, which President Trump took issue with, but made the point that it could be the consumer that will be then handling the burden of tariffs down the road.
Look, watch the evidence. I think I would be watching all the evidence, all the data carefully, recognizing that high-frequency data is extremely volatile and does not portend longer-term trends. But I think there's a very cogent case to be made that we are way above neutral in rates, and that getting rates back toward neutral would bring in many, many jobs. We have a 4.2% unemployment rate right now. We had, in 2019, a 3.5% unemployment rate with very little inflation. There's no reason why we couldn't be going back there, or I think with some of the supply side reforms going even lower than 3.5. So we've got a million jobs, maybe more, on the table that could be brought in if we don't get too obsessed with this last little bit of the inflation battle. And I think it is the last little bit of the inflation battle.
I have a response for which I think I should win the Nobel Prize for if it wasn't part of every monetary policy textbook already. And the reason I should win the Nobel Prize for, because I'm the only one talking about it, what I believe is potentially wrong, and I'm trying to say this in a nice way with David's idea, is it sees the Fed as a passive player in the tariff inflation outcome. I believe the Fed is a player in this outcome. It's not like you had World War II and yada, 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 Germany surrendered. There's a war in between, okay? And it's not like you have tariff inflation and it passes through the system and we're off to the races. How the Fed positions itself on the cusp of this price surge from tariffs, I believe, is consequential to the outcome. And under my scenario, Jay Powell is doing a huge favor to Donald Trump by jawboning and keeping the idea in play that the Fed is not going to roll over in the face of tariff inflation, but is taking essentially a somewhat hawkish view. Now, my theory and idea allows for David to be 100% right. Which is a nice thing, right, on a day like, but here's the thing. It could well be that on a fundamental basis, the Fed should be 50 basis points lower. However, it can't afford to affect that policy right now to ensure that it can be 50 basis points lower several months from now.
That's just kind of twisted around in a very deep way to say something that I just don't fundamentally agree with, Steve, which is we're running
Look at me to my face. Come on.
We're looking at the camera. Looking at you. I think we are in the process of describing a maximum employment and price stability mandate. Every measure, to me, that is important in price stability relates to inflation expectations and the anchoring of inflation expectations, which have been incredibly well anchored and continue to be incredibly well
Zervos, you
anchored.
make my point, though.
So why are we?
That's my point.
Why are we struggling with this idea that we need to have this highly restrictive monetary policy, which I know some people don't see it that way, I do, which is keeping jobs from the table and keeping the agenda from being as powerful as it otherwise would be with a lower rate structure, particularly, Steve, in places like housing, and particularly for those people that are most affected by higher interest rates, which tend to be those at the lower income distribution. I think it's a really difficult decision to sit here and say, we're fighting this last 50 basis points of core PCE.
Right, and we'll give it to you.
And
you'll get it.
And we're going to be really tough on that after we've had a pretty successful move of getting it off those highs.
I'm going to make 2 points.
When there's plenty of jobs to be brought back in.
I'll make 2 very quick points. One is I'm not sure I agree that we're leaving so many jobs on the table because we were 3.5, 4.2, general sense of. My basic point I think you made for me is why are inflation expectations under control? And one of the reasons could be the Fed's stance on policy.
Could also be the AI initiatives that are running through the entire system, and people are looking at technology. People are seeing a lot of supply-side narratives.
My point is they're seeing
the one big beautiful bill.
They're seeing higher prices at the store, in part because of tariffs, and they're not telling the survey respondents that I see higher prices in the future.
Because I think they also realize there's one-offs associated with tariffs, as I think the Treasury Secretary said, and numerous folks in the administration. These are not inflationary tariffs. They are one-off changes in the price level.
Agreed.
And I think the chairman of the Fed has said the same thing. You don't want to let that metastasize.
That's what he said.
Into something that de-anchors inflation expectations. But it is not doing that in any way, shape, or form. So why are we fighting? We're always fighting the last battle.
That's true.
We're always fighting the last battle. To go back to your World War II.
Are you still going to call on me at the press conference, even though I'm arguing with you?
Of course.
Thank you.
We've been doing this way too long.
Too long.
But back to your being a candidate for Fed chair.
Yes.
How actively did you engage with the administration? The last time I interviewed you, you were in Washington, so you're there a lot.
I have been in Washington a fair amount, Melissa. I've known the Treasury Secretary for well over a decade. I think he's one of the most talented individuals I've met in the marketplace, and I'm just so excited to see him transition into what he's transitioned to as a Treasury Secretary. It's unbelievable. I think he's just done a job that far exceeded even the loftiest of expectations, and I had lofty expectations. So I have been in touch with many people in the administration, and I've been discussing a lot of the same agenda points that I think they're talking about, and we've brought up on this show. So I feel really blessed, and I feel that I've been just put in a very high quality group of people. This 11 candidates that were discussed by administration officials, and I'm excited to sort of come to Washington and be part of that and serve my country, which I've done twice in the past at the Federal Reserve.
Yes, at the Fed, yes. You would bring definitely a different perspective being a chief market strategist going into the role of Fed chair, and I'm wondering how that would change your views, if any, in terms of now you talk to any Fed official and they say, we don't pay attention to what the stock market is doing. That's in your blood. How would that change? Would you just divorce that?
No.
Okay.
No, but I divorce a lot of my academic credentials and history when I come to markets, because every time I've let my PhD in economics guide me in trading, I've fallen flat on my face. So I learned very early that I need to not do that. If back in the Fed, I think one thing I do bring that's a little different is, I have that economics history, so I can speak their language, talk their models, discuss their 16 different versions of the Taylor rule and have a cogent debate about it. Generally speaking, I'm not a big believer in those things, but certainly studied them and still look at them and understand that they motivate many at the committee. I think it would be an incredible day to have more market savvy, more market competent people involved in the monetary policy decisions. We're seeing that at Treasury with our Treasury Secretary. He's a markets guy, but he has an academic background too with economic history and Yale. I think these are great additions, and there are a number of people in that group. My good friend Rick Reeder as well, who I think brings a lot of market benefits to the job. But there's also a lot of talent on the academic side there too.
Do you think that the idea of a Fed put for the markets would be much more vibrant and alive and well should somebody like you or Rick Reeder be put in the job?
I've spent my career talking about the Fed put, so I'm sure lots of folks who watch this will go, wow, there's the guy who discussed it and talks about the power of monetary policy, its ability to backstop, its ability to morph into something very significant in times of crisis. I was always a believer in balance sheet policies. There's many on that list that aren't so thrilled with balance sheet policy. So I do see the power in the Fed. I understand it and have been a believer in that backstopping structure. And I would bring that to the table for sure. I think anybody with a market background is going to be more sensitive to what the market signals are. Not necessarily the economic signals. I think it was Paul Samuelson who once said, that the stock market has forecasted 9 out of the last 1 recessions.
5.
I think it was 9, but
9 out of 5.
9 out of the last 5?
Yeah.
Okay. Whatever the number is. It was many more than actually happened.
Right.
Yeah.
And that's an economist talking, not a market person talking. Right. But again, I think there's signal, and I think I've spent 30 plus years of my career looking at what the signal of the markets bring to the economic outlook and also to the outlook for what is the right stance of monetary policy. Are they really doing the job set at hand? And the job set at hand is what Steve and I were just discussing, which is maximum employment and maintaining price stability and anchored long-run inflation expectations.
Dual mandate.
That's what you're there for. And I would argue today we could have a better employment picture than we have, and we may be taking way too much nervousness to the table about this inflation story. That's what I would argue.
Great conversation. Thank you very much, Steve Leisman. Thank you, David Zervos. Good to see you. We'll see you at the Fed. Just joking.
We'd love to be there.
Do not miss Steve's exclusive interview with Chicago Fed President Austin Goolsbee. That is tomorrow, 8:30 a.m. on Squawk Box. Coming up.